My name is Shivani, and I'm a tax partner at Sax.
And my name is Frank Centrella, and I'm also a tax director at Sax.
The President signed the Tax Cuts and Jobs Act into law on December 22, 2017. The goal and objective for today is to understand the individual provisions and excess business laws provisions. We will begin with individual provisions and then go into examples showing comparative analysis of two taxpayers between 2017 and 2018. Then we'll get into more detailed discussion on excess business laws provisions, and finally wrap up with a quick discussion on qualified business income deduction, which I think is the most discussed topic under the flow-through entity provisions. The provisions of the Tax Cut and Jobs Act are effective January 1, 2018, unless the slides mention a different effective date. Most individual provisions under the Tax Cuts and Jobs Act will sunset in 2025. These slides are broken down into two categories: pre-reform law and the law under Tax Cuts and Jobs Act. Pre-reform law means law which you will be using to file your 2017 tax return. So to begin with the tax provisions, start off with the tax rates. For single taxpayers, the 7 brackets are still in place, the highest bracket now being 37%. Earlier it was 39.6%. The Tax Cuts and Jobs Act has also introduced 4 new tax brackets. If you notice, the 12%, the 22%, the 24%, and the 32%. An individual taxpayer with over $500,000 of income will now fall into the highest 37% tax bracket. For merit filing joint, the highest tax bracket of 37% kicks in at $600,000. If you notice between the two slides, the marriage penalty still exists. So for example, if there are 2 single taxpayers making $500,000 each, they would pay around $301,000 in tax. But if the same taxpayers were married and making $1 million together, they would pay about $309,000 in tax. So the married taxpayer ends up paying about $800,000 more in tax. The preferential tax brackets for capital gains and qualified dividends are still in place. So pre-reform law, under the pre-reform law, the 15% and the 10% brackets, if you were in those brackets, you would pay 0% capital tax. If you were in the 25, 28, 33, or 35% tax bracket, you would pay 15% capital tax rate. And if you were in the highest bracket, the 39.6, you would end up paying 20% capital gain rate. Under the Tax Cuts and Jobs Act, those 3 brackets, 0%, 15%, and 20% are still in existence, but the thresholds of the income have slightly changed. For example, if you are over $479,000 and filing joint, you would end up paying 20% tax. There was a lot of talk of the Obamacare tax being repealed, but unfortunately most of these taxes are still in place except one small provision, which I'll go over on the later slides, which has been repealed. So for now, the net investment tax and the additional 0.9% Medicare tax on earned income is still in place. They have not been repealed for the years 2018 and going forward. Under the pre-reform law, each individual would get $4,050 for personal exemptions, and these exemptions were phased out once for married filing jointly, the individual income reached over $442,000. All these personal exemptions have been suspended for the Tax Cuts and Jobs Act. The standard deduction have been doubled under the Tax Cuts and Jobs Act. Now a married filing joint taxpayer has about $24,000 in standard deductions. That deduction was previously around $12,700 under the pre-reform law. In addition, the standard deduction for taxpayers over 65 and or blind was around $1,250 under the previous law, and under the Tax Cuts and Jobs Act, this standard deduction is now around $1,300. The child tax credit has significantly increased, almost doubled under the new provision. Under the new provisions, the child tax credit is now $2,000, up to which $1,400 of which is refundable. In addition, there's also a $500 non-refundable credit for qualifying dependents. We have an example later on in the slides which use how the non-refundable credit works out if your child is over 17 years old. The phase-outs for the child tax credit have also increased, almost more than double. Under the Tax Cut and Jobs Act, the phase-out would now be around $400,000 for merit filing joint. So, for example, if T is a single taxpayer and has one qualifying child, T's income is around $240,000, and it is over the threshold of the phase-out amount of $200,000. So he essentially will not get any child tax credit, and the whole $2,000 will be phased out. There was a lot of talk of repeal of the AMT tax. I believe in the House bill it was actually proposed to be repealed, but the Senate bill did have some version of it. In the end, at the compromise, the AMT tax still exists for individuals. It has been repealed for corporate taxpayers. The exemptions and the phase-out limits have significantly increased under the Tax Cuts and Jobs Act. Previously, the exemption was around $78,750 for merit filing joint, and the exemption now under the Tax Cut and Jobs Act is around $109,000. The phase-out limit under the Tax Cut and Jobs Act now is around $1 million for merit filing joint. So just an example where the exemption would completely be phased out for a merit filing joint taxpayer would be around $1.4 million, and for a single taxpayer, it would be around $781,000. The Tax Cut and Jobs Act also suspends the overall limitation on itemized deductions. I think this is basically because they are already limiting a lot of itemized deductions that were previously available to the taxpayers. I would appreciate if everybody could please mute their lines. The limitation on itemized deduction, as I said, has been suspended. Previously, itemized deductions were available to taxpayers with certain limitations. Individuals can take certain miscellaneous itemized deductions to the extent they exceed 2% of AGI under the pre-reform law. Most of these deductions are now suspended. Examples of these deductions are unreimbursed employee business expense, investment expenses, and tax preparation fees. So all these expenses will no longer be deductible as itemized deductions. Medical expenses for 2017, just note the date that this is effective 2017 and 2018, are now subject to the 7.5% AGI floor as opposed to 10% under previous law. There was a lot of talk about the state and the local income taxes at year end. You probably must have read a lot of articles about it. We got a lot of calls from the clients asking us whether they should prepay their taxes, they should not pay taxes. So just to go over the provisions and some of the IRS guidance which has come out since then, is under the Tax Cuts and Jobs Act, you are only able to deduct up to $10,000 of your state and or property tax. IRS came out with two guidance. One was on the deductibility of state and local tax, and the second one was on the deductibility of property tax.
Yeah, it's okay. I'm just put on here, so don't worry about it.
It's getting closer to the door.
Local income tax, the guidance says that if the tax was paid for years beginning after December 31st, 2017, it would be treated as if it was paid on the last day of the tax year for which the tax is imposed. So if you prepaid anything for 2018, you would not be able to get a deduction for it in 2017 because the tax was essentially not imposed till 2018. With respect to prepaid state and local taxes, the guidance says that the property tax should have been paid in 2017, and the main criteria here is that the property tax must have been assessed by your town before 2018. So you're in New Jersey, the February 2018 and the May 2018 taxes were probably assessed in 2017, so you could technically deduct those 2 quarters in 2017. In addition, New Jersey has also come up with guidance saying that they will allow the property taxes to be deducted only to the extent they relate to 2017. I don't think it's going to impact a lot of our taxpayers because the maximum deduction you get is $10,000 anyway, so I don't see a big impact about that New Jersey regulation that just came out. In addition, I believe a lot of states, especially New York, New Jersey, and California, are coming up with different proposals to see how they can reduce the impact of this deduction being lost to their taxpayers. New York actually came out with a 37-page proposal saying that different ways on how they could probably maybe tax the partnerships and the S-corps at the entity level, so the individual doesn't really have to pay tax, and that would actually be deductible at the entity level. So you just have to wait and watch to see what actually gets implemented by the different states. Big change in the mortgage interest deduction area too is previously you could deduct interest on mortgages up to $1 million and home equity loans up to $100,000 if it was secured by a qualified resident. Under the Tax Cut and Jobs Act, mortgage interest deduction limitation is now reduced to $750,000 for debt incurred after December 15, 2017. So this actually has a 2017 effective date. Some other provisions relating to that are that if you refinance an existing mortgage, you are grandfathered in. So, for example, if you had $800,000 of mortgage balance due in 2018 and you refinance it, you will still be okay, and you would be able to deduct interest related to that $800,000 because you are grandfathered in. There are also special provisions relating to written binding contract before December 15, 2017, and if you close before April 1, 2018. The key point to note here is under the mortgage interest deduction provisions that the deduction on home equity loan has been eliminated after December 31st, 2017. Charitable contributions. The AGI limitation on cash contributions has increased from 50% to 60%. Any excess amount which cannot be utilized in the current year is carried forward for 5 years. Previously, the AGI limitation on cash contribution was up to 50%. Alimony payment deduction. Before the Tax Cut and Jobs Act, alimony payments were allowed as a deduction to the payer and included as income for the recipient. The change here is for agreements executed or modified after December 31st, 2018. So you still have 2018 under which the previous law is going to apply. But for agreements executed or modified after December 31st, 2018, the above the line deduction for alimony payment is eliminated. In addition, alimony received is not required to be included as income.
A couple important things to note about this. With typical alimony agreements, it takes usually several months for everything to settle. So you don't actually have to receive payment in 2018 to have that agreement to continue to be deductible in 2019. it's very important just to be aware that these agreements need to be finalized and executed, even if actual payments are not made during the 2018 timeframe. And all existing agreements that are in effect that aren't modified will continue to be deductible.
Moving on to moving expenses. Moving expenses previously, if they were incurred in connection with starting a new job, were allowed as a deduction if the workplace was at least 50 miles further from their former residence. This deduction has been suspended under the new Act for everyone except the members of armed forces. The Act also tried to simplify the provisions of kiddie tax. So this is a significant change too. Previously, we actually had to link the child's return and the parent's return to come up with a tax calculation. But I think going forward under these provisions, the linking between the child's return and the parent's return will no longer be required. Under the previous reform law, earned income was taxed at normal applicable rates to a child, and any unearned income, which is basically your interest, your dividends, your passive income, over $2,100 was taxed at parents' rate. Under the new regime, earned income will be taxed at single tax brackets, whereas the unearned income will be taxed at the state and the trust brackets. Now, if you notice that the rates get steep pretty fast here, once you're at $12,500, you're almost at the top bracket of 37%. So, in effect, you will be paying the 37% highest tax bracket on all your unearned income which the child has. Personal casualty loss was allowed as an itemized deduction if the losses were related to fire, storm, ship, or theft. These losses were deductible once the losses exceeded $100 or when in excess of 10% of the AGI. All these deductions have been suspended under the new Act, except for personal casualty loss incurred in federally disaster declared area. So the key is that the losses should now be incurred under these federally disaster declared area, which the IRS declares from time to time once a casualty incurs. The loss deduction is still going to be subject to the $100 per casualty and 10% of AGI limitations. A significant change is made to the qualified tuition program or the 529 plans. Previously, only colleges, tuitions paid for colleges, fees and books for colleges were deducted, qualified as expenses under these qualified tuition programs. Now, these qualified higher education expenses include payments made to elementary school, your secondary school, public schools, private schools, religious schools also. The deduction is, however, limited to $10,000 per student per year for elementary, secondary, private, religious, and public schools. Recharacterization of IRA. Previously, taxpayers could unwind Roth IRA conversions. So if they converted a traditional IRA to a Roth IRA and the markets went down, you had the ability to unwind what you had done previously. Under the new Tax Cut and Jobs Act, unwinding is no longer permitted, except IRS just came out with a guidance that if you had conversions that were made in 2017, you could still unwind them till October 15th, 2018. We had discussed some of the Obamacare provisions that were still in place, like the net investment tax and the 0.9% Medicare tax. The one thing which is being repealed is the ACA individual shared responsibility. But the effective date of that is beginning in 1/1/2019. So the individual shared responsibility payments still need to be made for 2017 and 2018. A key thing to note here is that the mandate on the employers has not changed. The employers are still responsible for all the mandate that was placed by the Obamacare. I'm quickly going to go through 2 or 3 provisions on depreciation because even on a 1040, you could have a Schedule C, probably have some implications of depreciation. But we have an in-depth seminar on March 2nd and going over all the bonus provision depreciation or any changes on depreciation. So under the pre-reform law, for the first year, you could write off up to 50% of qualified property that was placed in service in 2017. Bonus depreciation was only allowed on new property. The significant change here is that for qualified property acquired and placed in service September 27, 2017, so this is a key provision that actually went into effect last year. The date is September 27, 2017, but before 1/1/2023, you could actually write off 100% of the property as bonus depreciation if it is defined as qualified property. There's also a provision whereby you can actually elect for the first year 50% bonus depreciation instead of 100% bonus depreciation. And these probably will come into place if you have significant NOLs and you think that you won't be able to utilize the benefit by writing off of the asset. A key change, which I think is a big change here, is that you can now take bonus depreciation on used property. As I said before, that pre-Tax Cut and Jobs Act, you could only take bonus depreciation on new property. Now, effective September 27, 2017, you could actually take bonus depreciation even on used property. One key thing to note here is that you cannot take bonus depreciation on used property if you're trying to buy it from a related party. So the related party provisions still exist. The expensing limit under Section 179 is also increased, almost doubled under the Tax Cut and Jobs Act. One key difference between bonus depreciation and Section 179 is to take the benefit of Section 179, a taxpayer needs to have taxable income, whereas you could still take bonus depreciation if you're in a loss situation. Under the pre-reform law for 2017, a taxpayer could elect to take around $510,000 as Section 179 expense, with phase-out threshold starting at around $2 million. Roofs, HVAC, alarm, fire, security systems for non-residential property were not eligible for Section 179. Under the Tax Cut and Jobs Act, now the expensing limit has increased to $1 million, with the phase-out starting at $2.5 million for property placed into service after December 31st, 2017. A key change here is that after December 31st, 2017, qualified improvement property now includes HVAC, alarm, fire, security system for non-residential property. So you could actually take Section 179 on all these qualified properties. The luxury automobile depreciation limit has also increased significantly, almost threefold. So for passenger automobiles that are placed into service after December 31st, 2017, the first year depreciation, which you could write off, is $10,000. The second year is $16,000. The third year is around $9,600, and the fourth year and later years would be around $5,700.
Thank you, Shivani, for going through all those provisions. As you can tell, they were quite numerous and not easy to put in quick bullet points so everyone could see them and have them in front of you. The remainder of our seminar will be devoted to going through a couple of examples that will show the impact of some of these changes and also address some additional provisions that may impact some of our taxpayers. So, once again, my name is Frank Centrella, and I'll be taking you through the rest of the seminar. So the first example you'll see on your slide, we have a married taxpayer, A and B, who has 2 children, ages 14 and 19 years of age. The taxpayers have $250,000 of wage income and $2,000 of interest income. For both years, we're assuming all the same facts. So they incurred $24,000 in medical expenses, $16,000 in real estate taxes. They pay $10,000 in state income taxes. They have a mortgage and pay $6,000 in qualified mortgage interest expense. And they also have an additional $12,000 of other itemized deductions. In the example on the next slide, you will note that for both years, income is not going to change because this bill is mostly dealing with deductions and not income. We're going to focus on each line item. So let's go through 2017 first. As I mentioned, there were four taxpayers here, the married couple as well as the two dependents, so they qualify for a personal other deductions, which they're only able to deduct because of other limitations, of $6,960. So that gave the taxpayers a total of $46,560 worth of itemized deductions. You compare that itemized deduction to your standard deduction, and you take the higher deduction. For 2017, you add both your itemized deductions and your personal exemptions. You get total reductions from your gross income of $62,760. So their taxable income for 2017 this year would have been $189,240. That tax generated an income tax of $39,872. However, these taxpayers were in the alternative minimum tax and had to pay an additional tax. Move forward to 2018. Taxpayer deduct your personal exemptions. Medical expense limitations did not change, so you still get $5,100. Charity is still allowed, $2,500. Their tax deduction is now limited to $10,000. Doesn't matter what tax you pay, that's all you can deduct, the maximum. Mortgage interest is allowable, so that's still a deduction. You are no longer allowed the miscellaneous itemized deductions, so now that's been eliminated. So when you add all those deductions together, you get $23,600. However, standard deduction is actually greater than that. So these taxpayers will actually itemize in 2017. In 2018, will use the standard deduction, and they would have a gross taxable income of $228,000. The regular income tax on that number is $43,299. They do have one child who qualifies for the new enhanced child care credit, so that number gets reduced by $2,500, generating a final federal tax of $40,799. It's an interesting result because of tax reform. Even though this taxpayer lost significant itemized deductions, they actually ended up saving $4,000 on their personal income taxes. So that's our first example that I would like to go through. We've also incorporated a second example for you to review, saying what happens if you make a lot more money. In this example, the taxpayers still have two children, the same age, 14 and 19. They now have wages of $1 million. They still have interest income of only $2,000, and their itemized deductions, $24,000 in medical, $16,000 in real estate taxes. Now they paid $70,000 in state income taxes. They also incurred $6,000 in mortgage interest, and they still had the $12,000 in itemized deductions. So on the next slide, I'll go through the example on how that works for 2017 versus 2018. Their gross income is $1,002,000. Since their income is so high, they get no benefit for personal exemptions, nor do they get a benefit for medical expenses in either year. Charitable contributions in 2017 was $2,500. Their gross tax deduction, when you add the real estate taxes and state income taxes, is $86,000. They still get interest expense of $6,000. Once again, since their gross income was so high, they get no benefit for those other itemized deductions. For 2017, since their income was so high, a portion of their itemized deductions get limited. So in this case, it was $20,646. So their total itemized deductions that are allowed are $73,854. Since obviously that's higher than the standard deduction, that $73,000 reduces their adjusted gross income, giving them taxable income of $928,000. That taxable income generates an income tax of $312,777. We'll go to the next step now for 2018. Income remains the same. We do not have any medical expenses. Charitable deductions are the same. Once again, we lose all of our state taxes, real estate taxes limited to $10,000 only, and we're also able to deduct $6,000 in mortgage interest expense. Since our total itemized deductions are once again below the standard deduction, you utilize the standard deduction of $24,000. So now you have taxable income of $978,000. However, when you go through the actual tax calculation, you will note that their regular income tax is significantly lower than in 2017. It's only $301,000. So under the new tax bill, this taxpayer would actually end up saving $11,500. The moral of this story and the moral of the tax changes that passed is everyone's situation is going to be unique from each year, and you have to really go through the details to figure out if you're actually positively or negatively impacted. But we're finding more people are positively impacted than we anticipated, which is some good news for everybody on this call, I hope. Okay, the remainder of this will be devoted to some new provisions that got modified during the Tax Reform Act. This is a brand new concept that was introduced in the Jobs and Cuts Act and it will be effective for taxpayers starting in 2018. The concept deals with excess business losses. An excess business loss in a tax year is the aggregate of the aggregate deductions and losses for a taxpayer's trade or business as compared to the income or gain from those activities. If you're married, the excess losses cannot exceed the income by $500,000. If you file otherwise, the limitation is only $250,000. If you have excess losses in excess of those two threshold amounts, any additional aggregate amount will be carried forward as a net operating loss to the following year. This rule is applied after passive activity losses. This limitation is not calculated at the business level, which is the S corporation shareholder level or the partner level, but solely at the ultimate beneficiary level. So that would either be the trust, the estate, or the individual related to this. Spouses with separate businesses interests will be aggregated for purposes of this limitation. That's actually a better result, so you don't have to apply this limitation by a taxpayer. It'll actually be applied with the married couple. I do have an example for you to review. I think you would find this useful. In 2018, A has deductions and losses from his business of $900,000 and income and gains of $1,000. His spouse has wages of $600,000 from her employer. Assuming A and B file a joint tax return, we calculate the excess business loss to be $100,000 as noted below. You take the total deductions from the business, compare it to the total income, that actually gives you $600,000. The threshold is limited to $500,000. So this taxpayer would have an excess business loss of $100,000 in 2018. This loss will be carried forward as a $100,000 net operating loss and will be available to the taxpayer in 2019. You will note that obviously the taxpayer would have taxable income this year because under 17 rules, this loss would be used to offset the taxpayer's $600,000 in wages. However, we can only use this loss up to $500,000, which means the taxpayers would have $100,000 of taxable income. I do have an example. That was the example on that. So we'll go to the next slide. There's something new that's unique for 18 forward, dealing with net operating losses. The old rules allow net operating losses to be carried back to 2 prior tax years, and then if they were not fully utilized, they could be carried forward 20 years. There was a limitation for certain taxpayers. Regular tax was allowed 100%. The alternative minimum tax, you can only utilize a net operating loss up to 90% of your adjusted A&T taxable income. That's the old rules. For new net operating losses that are incurred starting 2018, those rules have changed, and I'll go through them right now. Net operating loss carryback provisions are repealed. Net operating losses generated after January 1st, 2018 will be carried forward. These net operating losses do not expire. They have an indefinite carry forward period. The other provision that's important to note is the net operating loss deduction for losses generated starting in January 1st, 2018 will be limited to 80% of a taxpayer's income for that year. So even though you have a net operating loss, you still may have a tax in the subsequent year. Something to be aware of for next year. Now the next page is probably what some people have heard a lot of information about and is very confusing to a lot of people. We actually have a seminar coming up next week to address this further, and I highly recommend for anybody who has businesses that they attend and listen to that seminar, because that will provide more clarity on details of this, which I'm going to kind of talk over in very broad strokes. But I do want to go through it for you so you should be ready for the seminar next week. Okay, the new deduction is a deduction that's allowed on qualified business income. This deduction will be limited to 50% of wages or the sum of 25% of W-2 wages plus 2.5% of the unadjusted basis of qualified property. I will have a very simple example to review that so it's a little easier to follow. There's certain thresholds that we have to deal with. If your taxable income is less than $315,000 if you file a joint return, or $157,500 if you're a single taxpayer, you don't have to worry about these limitations. If they're above these limitations, we have a phase out that we have to consider. The phase out is $100,000 if you file jointly and $50,000 if you file single. So there'll be 2 calculations that us as your accountants will have to perform. So we'll be able to educate you as you go through this process. Okay, so let's go through the provisions of qualified business income deduction. It is a 20% deduction for partnerships, S corporations, and sole proprietors and this relates to the ordinary income generated from those activities. Investment income is excluded from this deduction. Earned income that you earn from these activities are not included. So if you get a salary from your S corporation or you receive guaranteed payments from your partnership, they will not be part of this calculation. Any business income must be effectively connected with a U.S. trade or business. So you have foreign branches or you have a global entity, you need to account for that. And this deduction will end starting in 2026. One interesting note, if you have a complicated business structure that also has trusts and estate ownership, those entities will also receive this deduction. Unfortunately, this provision applies to our business. Qualified business income is limited for certain taxpayers providing professional services. The law as passed has provided certain examples of what limitations or what this will apply to. So medical services, law, accounting, actuaries, performing arts, consulting, athletics, financial services, and brokerage services. All those people will not be able to take the deduction if their income exceeds the thresholds I mentioned before, the $315,000 if you're married, $157,500 if you file any other way. The good news is if you're an architect or engineer on this call, you don't have to worry about this problem. You don't have to deal with this issue. I do have a very simple example that I'd like to go through. I'll try to keep this as brief as possible. B is a 30% owner of ABC LLC. This LLC has ordinary income of $3 million. This LLC also paid wages, W-2 wages, of $1 million and has total unadjusted basis of property of $100,000. For people on this call, unadjusted basis of property means assets that you own that you capitalize, so building, equipment, etc. So let's go through the starting place where our gross deduction is calculated. B would be entitled to a deduction, which is the lesser of total income from the partnership, which is $3 million, times his share of ownership, which is 30%, or $900,000. So the maximum deduction B would receive in 2018 would be $180,000. However, there are additional limitations that need to be addressed. So there's two ways to calculate this limitation. The first limitation is the W-2 wages, which we mentioned on the prior slide. The gross wages on the LLC were $1 million. B's share is 30% of that, or $300,000. So if we multiply that $300,000 times 50%, the maximum deduction is $150,000. Then there's a secondary calculation that would be part of this process where you incorporate 25% of those wages. So you see that limitation works forward to $75,000. And then this is the other part I mentioned, the fixed assets or the unadjusted basis in property, which they had as $100,000. His share of that is $30,000, and that's just gave him a limitation of $750. So if we flow to the next slide, we figured out that B will be entitled to a deduction of $150,000. This calculation is limited to the gross number, which is that 20% number, of $180,000, or the greater of the two limitations that I calculated on the prior slide, $150,000 or $75,750. The one second provision we mentioned with the unadjusted property was put in there for certain individuals who own real estate properties that they rent out. Those entities, those companies don't have a lot of payroll, so Congress felt that those entities would also be entitled to deduction. So some of you who have rental properties out there will also receive this deduction if you have net income, and you'll have to go through the secondary calculation to figure out your limitation. Okay, so if they haven't changed enough, we have to talk about additional changes, but this will be our final slide for today that we can go through. These are the estate and gift provisions that will impact taxpayers for 2018 go forward. The good news is they raised the estate exclusion for federal estate and gift tax purposes to $11,200,000. That limitation will be adjusted for inflation down the road. Please bear in mind, your state that you reside in may have different rules. So for example, New Jersey currently has no exemption, where New York State has a $5 million exemption. So please be aware there are differences from state to state. The generation skipping tax that gets involved with certain estates, that exemption has also been increased to $11,200,000 for all transfers made after 2017. The fiduciary income tax rates have also changed. They were mentioned on a different slide. We still have the tremendous compression on the rates, but the rates no longer max out at 39.6%. They've been reduced to 37%. One other provision that may apply to a few of our taxpayers, there was a time where if you were a non-resident alien of the United States, you could not own shares in an S corporation stock. There has been a carve-out to allow that to happen if you structure your ownership where you create what's known as an electing small business trust. That non-resident alien could be a beneficiary of that trust, and you could still preserve your S election. An important thing to realize with these estate provisions as they exist right now, there's a lot of planning opportunities that exist at this current moment. They have to incur where you have to figure out what your gross net worth is. Maybe you have to review your wills in lieu of this. If you're only worth $12 million and you were going to leave your spouse all that money in trust, you may want to change your provisions in your will. So there's a lot of opportunities available for this. So I would be looking at this a little bit differently. You probably want to be sitting down with your accountants and discussing you will as part of your 2017-2018 tax review. And I think that's all I wanted to discuss at that point. If you have any questions, type them in on the chat bar and we can go through them for you. Thank you very much. Please note that there are other seminars which will also be on the back of this slide. I mentioned the Qualified Business Income Seminar. That is on February 18th at 10 a.m. I highly recommend any business owner on this listen to that discussion. Oh, and that's Shivani and myself. If you have any specific questions, feel free to email us as well. Those are the upcoming webinars that'll be coming up on different areas of the tax bill that changed. And thank you so much for listening.
Yeah.
And if you have any other questions, please feel free to reach out to us. Thank you.